welcome to the Monday Futures Market Outlook for February 27th, 2012. This is Patrick Sresna. eMiniSource.com has a live trading room that trades every single morning. If you would like to try out our trading room, a complimentary membership is available on our website. As always, we start off with a chart of the US dollar index futures, and we more or less have suggested that the US dollar would spend a good chunk of February, if not even a good chunk of March, consolidating near or around these lows. We think that there is even a possibility of a short-term push down to 77.50, but doesn't necessarily have to be so. We, in the bigger picture, believe that this will emerge as a buying opportunity for the US dollar off of these lows, but not necessarily that it's going to be a straight line move higher from this level that begins right now. But overall, we are looking for supports to hold here. We're going to be watching where short-term reversals up start occurring, and how this price action behaves in these support lines. One of the reasons we are bullish on the US dollar is primarily because we are relatively bearish the euro. Now, we drew this on over the last month and have been tracking our drawing, suggesting that this wedging formation on the euro would test this 135 to 136 level. We're getting a little bit of a reversal candle coming today after a proper test of that 135 that occurred. But in the bigger picture here, we think that the euro now has a limited upside. Now, we certainly cannot rule out the possibility that there will be one or two additional thrust attempts to test the 136 level on the upside, but this is a place where we're going to be looking for the highs of the first quarter to come in. Next, I'd like to take a look at this 30-year Treasury bond, which has once again successfully bounced off the 140-141 focal point. Again, we're right now in the middle of that trade range. Are we going to be able to see strength that pushes it to retest the previous highs again? Is yet to be seen, but one good omen would be a break of this 144 level. In the same regard, any substantial reversal of this bond off of this 144 level and retest down back at the low, we still are open to the idea that Treasury bonds could still have one more good corrective pattern. But in the bigger picture, if we look at our 2012 forecast, we are actually bullish bonds. So every time we're looking for these breakdowns, we're just trying to see where and how the Treasury bonds consolidate over the first quarter of the year, and then we'll be eventually looking for a substantial buying opportunity, but we don't necessarily believe it will present itself here at this stage in late February. Next year, when we take a look at copper futures, copper it has an interesting pattern here. Back just a week ago, it did actually break to a lower low, and now it tried to rally. And if for whatever reason this rally fails without breaking above the 383.90 zone, it'll create sort of like a head and shoulder style formation at the top end of a wedge right into the retracement zones where we were targeting the highs of the first quarter of copper to come in. So again, this is going to be a crucial moment for copper because any failure of copper here, especially any substantial break below, let's say, the 375 level, would open the window for copper to have a good cycle here. Next year, when we take a look at crude oil, we drew on this wedge. We were looking for crude oil to have a bullish break on the upside, and subsequently it did make the break. We were targeting the 108 to 110 zone, but we at this stage wanted to simply point out that the highs of 2011 actually occurred up toward the 115 area. There is a chance that that crude oil could just simply consolidate here and still burst up toward 115, but our initial target of the 108 to 110 has been met, so we are taking some off the table, lightening up the position, but we are still not ruling out the possibility that there could be one more thrust higher. If we have a little bit of selling and then a failed rally attempt, that just like we sort of saw in copper, that would be a little bit more concerning, but we haven't seen anything like that just yet. Next, we're going to take a look at gold futures. We suggested that flag that occurred in the first few weeks of February, that if it broke, we could see a solid test of this 1,770 to 1,800 focal point up above. We're getting a little bit of hesitation here on gold. Now, obviously, that doesn't mean that there's a reversal imminent here, but we do believe that this is substantial overhead resistance that could reverse gold. So we're going to be watching that carefully. We still, in the bigger picture, believe that this is sort of like a big rising wedge that's coming up to retest some of these high points. If gold starts to fail in these areas and begins any sell cycle that for whatever reason broke 1740 and then maybe takes a go at the 1700 level where the lows of February came in, that would be very concerning. It would be giving some indications that gold could put in a major top and reversal, but again, there's no price action to confirm that. We're only simply suggesting the things that we would be looking for that would make us concerned about the price of gold. Next year, when we take a look at the weekly chart of the S&P 500, we always like to take a look at it going even 30 years back, and we suggested when we plot an 80-week moving average on there how it depicts the bull and bear market cycles the market has gone through. We obviously went through some crossovers back and forth over here, but in general right now we are distinctly trading above the 80-week moving average, with it pointing higher and us retesting the 2011 high. We still believe there is room for this market to remain relatively bullish, and there's no weekly chart indication yet for a major reversal. When we take a look at the S&P 500 and the daily charts, even though on those weekly charts there's no indications, the daily charts are certainly giving us the indications that a substantial top could be forming or being put in. One of the scenarios we looked at was that we needed to see some profit-taking cycle. We don't believe that the first wave of selling here has to spill into anything that looks like a market crash. Really a healthy profit-taking cycle that sees 40 to 80 S&P points lower is the most likely thing. But as we were indicating last week, that the market could spend a little bit of time up here before that pattern really does kick in. And so it will be very interesting to see whether or not last week's lows are beaten on the downside. That would be the first warning sign that one of these corrective patterns is underway. But when we do see a break, we think that we could see as low as even 1260, but more than likely 1320 is going to be our first initial downside test zone, and then potentially a test of the focal point in the 1275 to 1290 would be our second wave of targets. And nonetheless, we will more than likely be buying this pullback. So even though it sounds bearish when we're talking about this corrective pattern, but recognizing that we are not looking for a crash. Swing traders can try to trade that lower, but really in the bigger picture, our traders and investors should be focused on trying to buy that pullback. Very quickly, just a review of our key intermarket observations that we talked about. We are right now in the short term neutral at US dollar, but we are longer term bullish. Commodities, we are bigger picture bearish, but remain neutral on them in many cases, particularly even slightly neutral to bullish on oil, but we're neutral to bearish on copper, and starting to see a lot of other commodities show the initial signs of weakness. Bonds, we continue to still have a bias that they could correct at some point, but big picture or longer term, we are bullish bonds. On the short term, we think that stocks will go a little bit lower, but our bias remains that into April we could still see higher highs on this market. But once we get past the first and in the middle of the second quarter, we're going to go far more neutral, if not a little bit bearish, on the stock market. So we think that the sell in May and go away kind of cycle could really play out again this year. That was your Monday Futures Market Outlook. Thank you for joining me.